Hello and welcome to the Black Entrepreneur Blueprint Show. I am your host, Jay Jones. Black Entrepreneur Blueprint was created specifically to educate and inspire Black entrepreneurs to launch, build, and grow successful businesses. Join us as we help build an economic power base in the Black community by promoting business ownership. If you are currently an entrepreneur or want to be an entrepreneur, we invite you to join us every week here at Black Entrepreneur Blueprint.
Welcome to the Black Entrepreneur Blueprint, episode number 186. I'm your host, Jay Jones, and today we have another informative show for you. Today's show topic is Be the Bank. Stop borrowing and start lending. 5 steps to becoming a private lender. All right, I'm going to repeat that. Be the bank. Stop borrowing and start lending. 5 steps to becoming a private lender. And today's show is near and dear to my heart for several reasons. First reason is this is the beginning of 2018, and I need to take my business to a different level. And in order to do that, I need to start thinking bigger, making bigger goals, in turn, making my business bigger. And I have to start thinking deeper. A lot of times as entrepreneurs, we think superficially, but let's start digging in deeper and looking at things and trying to build our business to even bigger than we could imagine it. That's what today's show is really about. And any of you BEB family members who've listened to the show over the past 3 years know that you probably heard me talk about when I owned my mortgage business for about 10 or 11 years. I was blessed to own a successful mortgage business that did millions of dollars in not just sales, but in revenues each year. And I was blessed to be able to work with a lot of professional athletes and entertainers due to some of my college connections and also just network. One of the biggest regrets that I have is I was not able to put together a private lending entity with these professional athletes and entertainers. I had talked to tons of them about pooling resources and now becoming the bank. And the funny thing is, as a mortgage broker, I did a lot of their residential properties and even commercial properties. And I'm just looking at the fees that these lenders are making from these loans. Now, they're sitting back while me as a mortgage broker, I'm out there, soliciting business, and I'm using their money for them to make money. And it came to me, I said, you know what? We can do the same thing on a smaller scale to start off. These are people that have resources. They have excess resources where they're not using all of it. And my whole objective was to help bring a couple of the guys together, form this entity, and start lending money. And we're not talking about traditional bank loans. Today, we're going to just focus on 2 of the type of loans that we talked about back in the day, which were hard money loans and transactional funding. And before I get to that, though, I want to go through the actual 5 steps to becoming a private lender. Now, I know it may sound like a daunting task, but it's actually not. And that's what we're going to get into today, because one of the things is, guys, when we control the lending entities, we're able to lend to who we want to lend to. So, of course, you have to be risk aversive. You want to make sure that you don't put out bad loans. But when you do hard money lending and transactional funding, the risk is very limited. So we'll get into that as we continue in today's show. So step number 1 to becoming a private lender. Number 1, you need to pool your resources if you don't have a lot of resources by yourself. Now, if you're a professional athlete and have millions of dollars that you can access, you don't really need to pool anything because you have all the money. But if you're regular folk like us, you may need to go to 3, 4, 5 serious-minded people, because not everybody is serious. They talk a good game, but when it's time to put money on the table, you can't find them. So you want to pool resources. It could be 10 people putting in $10,000, 20 people putting in $5,000, or whatever it is. You don't want to have too many partners because it gets crazy. So you want to create a partnership with others, and you want to use your own money. So you're pooling your resources to fund your bank. That's step number 1. Step number 2 is to determine what types of lending you want to do. Now, what my proposition was, so I didn't have these guys' money out there for 20, 30 years, was to do hard money loans and also transactional funding. And they're short-term loans, both of them. And I'm going to give you explanations or details on both. And I'll start off with hard money loans. Hard money lending is usually for residential or commercial properties that is valued at 65% LTV or less, loan to value. So that means if you have a property that's valued at $100,000, the maximum you would loan on that is 65%, which is $65,000. And the reason it's called hard money is because there's points up front and there's interest. And the way you're protected is if you loan somebody $65,000 on a property that's valued at $100,000, if they don't pay you back, you foreclose and you're going to get your money back because the value of the property is at $100,000. You only lent them $65,000. So if you sell the property, whatever condition it's in, and it's worth $100,000, you'll get your $65,000 back. So that's hard money lending. Usually with hard money lending, the lenders charge anywhere from 2 to 6 points up front. And a point actual is 1%. So if I give somebody a $100,000 loan and I charge them 5 points up front, that's $5,000. That's the fee that they have to pay me up front. Now, in addition to that, interest rates on hard money loans can go anywhere from 9 to 14%. And obviously, based on the interest rate climate, that can change. But hard money loans are higher interest rate and they're more points up front. So just to give you an example, on a $100,000 hard money loan, 5 points up front is giving me $5,000 up front. That's before I lend money to first. Once that loan is signed, I get $5,000 up front and I'll get anywhere from 9 to 14% interest. And hard money loans are usually a maximum of 6 months. What a hard money loan is for normally is to buy a property that you can't get traditional financing on. So if you're looking to buy a property that's you're looking to fix and flip, if it's a residential property, if the property isn't up to code, the roof is jacked up, it can't get traditional FHA or VA or conventional financing. So what happens is, unless you have the cash to buy that property, then you're not going to be able to get it. And if you don't have the cash, usually the only place you're going to get it from is a hard money lender. Once again, hard money lending is a short-term loan, usually up to 6 months, to usually buy the property, give the new owner of the property time to fix it up. Then that loan is over. In 6 months, they have to pay you back that money with the interest. And once again, you're getting anywhere from 2 to 6 points up front. And your interest rates as of today, and they're going to vary based on the property, are anywhere from 9 to 14%. That's the lending type number 1. That's hard money lending. The other type of lending that I proposed to the athletes and entertainers was transactional funding. And what transactional funding is, this is for people that wholesale real estate. And I'm just going to go back. I did a show, episode number 131, I believe, about how to make money in real estate. And I talked about wholesaling. So for those of you who don't know what wholesaling is or haven't heard that episode, go back and check it out. I think it's 131. But what wholesaling is, you find a property that somebody is selling. That person that's selling the property is A. He's person number A. You're B. You're buying that property. So say somebody has a property worth $100,000. They owe $50,000 on the property. They're in financial trouble. You go in, you offer to buy that property at $60,000. What that does, it enables them to pay off their mortgage, put $10,000 in their pocket. Now, you purchased the property from A at $60,000. Now, remember, the property is valued at $100,000. Now, what you do is, since now you have control of that property, you've signed a sales contract, you're going to close within 30 days. Before you close, you try to find somebody to buy the property from you for above $60,000. So if you have connections with real estate investors, then you could say, hey, look, I have this property that I'm selling for $70,000 that's worth $100,000. And they're party C. The seller, the original seller, is party A. You're party B. The end buyer is party number C. So what happens is, it's a win-win for everybody. So you buy the property for $60,000 from party A. His mortgage is $50,000, so he'll net $10,000. You take the property you just bought for $60,000, you sell it for $70,000 to the end buyer, who is party number C. you make $10,000. Now the end buyer, party number C, the value is $100,000 and he only paid $70,000 for it. So he has $30,000 in equity. In the old days, you could actually do that transaction in one day without coming to the table with any money. But based on different laws now, you're not able to do that. So if I don't have the $60,000 to come to the table to buy that property from the original seller, then I can't wholesale it for $70,000 to the end buyer. So what transactional funding is, transactional funders will come in and say, hey, Jay, I see that you need $60,000 for about 2 days. So we're going to contact the closing attorney or the title agent, depending upon what state you're in. And you're going to have to do the purchase from party A and the sale to party C in the same attorney's office or title agent's office, pretty much at the same time. It's called back-to-back closing. And what we'll do is we'll lend you that $60,000 for 1.5% to 2.5% of what you're buying it for. So you'll make 1.5% to 2.5% if you're the transactional funding lender. And so how the process works is, so I go to closing with party number A, the seller. My $60,000 is wired in from the transactional funding. I pay the initial seller $60,000. Soon as that is done, then now, since I own the property, I sell it to the end user, party number C, for $70,000. And at that closing, I get the $10,000 spread. But remember, if I don't have the $60,000 to do the first closing, I'm not going to be able to do the second closing. So that's what transactional funding is used for. So what happens is the actual transactional funding lender will wire the money to the closing attorney or the title company. It'll sit there in the escrow. And once it's done on the HUD, which is the settlement statement, the transactional funding company will get their money back, the $60,000 plus anywhere from 1.5% to 2.5%. So if they lent me $100,000 for 2 days, they can make anywhere from $1,500 to $2,500 for 2 days of lending the money out. If 2 days, sometimes I've seen it in 24 hours, money gets wired in right the day of the closing, bam, the closing gets done, the money gets wired out back to the transactional funding company that afternoon. So you're looking at a maximum usually of 72 hours that you're lending that money. So yeah, it doesn't sound like a whole lot of money, but if you're making $1,500 to $2,500 for 3 days, and say you do 10 of these transactions a month, that's what, $15,000 to $25,000 using the same $100,000 or whatever dollar amount it is. So once again, that's very short-term lending. All right, so let's just refresh a little bit. 5 steps to becoming a private lender. Number 1, pool your resources. Number 2, determine what type of lending you want to do. And the type of lending that I proposed to the entertainers and athletes was hard money lending and transactional funding, because they're short-term loans, meaning that your money's not going to be out there 5 years, 10 years, 30 years, or whatever. You'll be able to continue to use your money to make more money. All right, step number 3 in becoming a private lender is to create your legal entity. Create your legal entity. So you want to have an LLC or partnership, and you need to have an attorney, or especially a real estate attorney, create your loan paperwork and legal documents. Now, a lot of loan paperwork is standard, so it's not going to cost a lot of money. You may have to make a couple of tweaks here or there, but just have to make sure that your documents are legal. And there are places where you can find lending documents, which are pretty standard. Okay, so that's step number 3, create your legal entity. Once again, I would recommend that you do an LLC, because it's a separate entity into and of itself. It's not J. Jones, so it's not associated with my personal or social security number. Something goes wrong, which in this type of business, it wouldn't, then everything you're dealing with is actually on that entity, that LLC. All right, that's step number 3. Step number 4, you need to market your services. So if you go online right now and you look up hard money lending or transactional funding, you will see a ton of people come up in the Google search. The way to really start to dig into this is working directly with wholesalers and investors. So if you have a wholesaler that comes to you for transactional funding, you do a good job. They continue to keep buying properties, flipping properties. They tell somebody who tells somebody who tells somebody. Now you have a whole bunch of wholesalers or investors looking to come to you for your money. Same thing with hard money. Most people that buy properties with hard money are investors. They're looking to buy properties, rehab them, fix them, or flip. All right, so you need to market your services. And step number 5, make sure that you have your legal and financial records in order. There's certain requirements you need when you lend private money. It's nothing crazy, but when you're recouping interest, there's certain documentation that you do have. So you just want to make sure that you have a good team around you, your attorney and somebody, a CPA, to make sure that you're handling the money correctly and reporting the money correct. So once again, today's show is Be the Bank, Stop Borrowing, and Start Lending. 5 steps to becoming a private lender. Once again, I'm going to go through the 5 steps, but if you go to episode, I believe 131, I talked about becoming wealthy in real estate, and wholesaling was a part of that, and also fix and flip and a couple other options that we do have. So step number 1 today is pool your resources to fund your bank. If you don't need to pool resources with anybody and you have the resources, that's even better. Step number 2, determine what type of lending you want to do. And once again, I propose to the guys hard money and transactional funding because they're short-term loans. Step number 3, create your legal entity, an LLC or a partnership, and make sure you have an attorney create your loan or review your loan paperwork and legal documents. Most of the loan paperwork out here is pretty self-explanatory and is pretty generic. So you may have somebody just look over it and tweak it to make sure that yours are on par. Step number 4, market your services. Once again, you can do that online or get out there in the community. If you see somebody rehabbing a house, hey, stop by, give them your card. Or just network. Once again, if you go on to Google right now and you Google hard money lending or transactional funding, tons of people will pop up. Step number 5, make sure you have your legal and financial records in order. Certain requirements are needed when you lend money, even private money. When you're recouping interest or getting interest payments, you need to just make sure that financially you're reporting everything correct. The benefits of this type of lending, or these 2 types of lending, are that your risk is negated. So with hard money lending, once again, if the people that borrowed the money don't pay for the actual loan, repay you, you foreclose and you sell the property and you get your money back. Remember, you're only lending up to 65% of the value of that property. So you're never going to be upside down unless something drastic in the economy happens. Another benefit is their short-term loans, meaning that you can keep your money working for you, especially with transactional funding. If you're lending money for 24, 48, or 72 hours and you're making 1.5% to 2.5% on that money and you're just continuing to re-lend it, that's all day, every day. And another benefit is there's always a big demand for money. In this scenario, we're talking about money for real estate. But there's always a big demand for money in real estate. There's always going to be the fix and flip guys. There's always going to be the wholesale guys. There's always going to be the fix, buy and hold guys out there. And when I say guys, I mean men and women. There's always going to be a need for money. Now, since this show is about being the bank, it's really talking about real estate. And it's funny, while I was doing this show, I was just thinking about a real estate strategy that my dad told me about years and years ago, which I thought was pretty cool. And I'm just going to throw this out there as a little bonus for anybody who's out there buying and holding or whatever. But he used to call it the free and clear system. And so what he would do, my dad was in the real estate business. He was one of the first black commercial realtors in the city of Philadelphia. Then he went to residential real estate and insurance. But one of the things he talked about back in the day when he used to buy houses, he would buy 2 houses at a time. He would buy and rent the properties out. So he would buy 2 houses at a time. And his philosophy was this: I'm going to buy these 2 houses at the same time, similar type properties. And since he was in real estate, a lot of times they'd be on the same block or a couple of blocks away from each other. So their comps would pretty much be the same. Square footage, price, the whole shebang. So what he would do, he'd buy them and he'd get loans on both properties and he'd fix them up and he'd rent the properties out for a year, 2 years, or whatever. When it got to the point that one of the properties appraised in value enough where if he sold that property, he could take those proceeds and pay off the first property that he bought, that's what he would do. And so now, instead of having 2 properties that you have leveraged, he would take that second property and pay off the loan on the first property. So now he has 1 property that's free and clear. And he would continue to do that. So 2 becomes 1, but it's free and clear. 4 becomes 2, but they're free and clear. 6 become 3, but those 3 are free and clear. The philosophy was this, and it especially is great when there's economic turmoil. And I'll give you a real life example. One of my good friends is a real estate investor. And during 2007, 2008, with the economic crisis, he had about 13, 14 properties. And he was leveraged. I mean, he was buying as many as he could because they were giving away mortgages back in the day. So what he did was, you know what? Let me go ahead and buy as many properties as I can. I'll rent these properties out and I'll get as much rent as I can. And as I continue to rent them and the people are paying their rent, I'll continue to knock down my mortgage and increase my equity in the property. Problem was when the downturn came, people losing their jobs, the real estate market, the whole financial markets were out of whack. People couldn't pay those rents. So when his mortgages were due, mortgage payments on those 14, 13 rental properties, and nobody was paying the rent, guess what happened? He couldn't make his mortgage payment. And what happens when you can't make your mortgage payments? They take your house. Right? Especially investment property. And if you have equity in the property, the bank is really going to take your property quick. If you're upside down in your property, a lot of times the lender isn't even going to bother with you right away because they know they can't get their money out. But if you have equity in the property and you go into the foreclosure, they're going to try to foreclose on you and sell their property to get their money back. So what happened was when he couldn't pay all these mortgages, he ended up losing all of his property. Now, just imagine if he used that free and clear system that my dad was telling me about years ago, where instead of having 14 properties that he had leverage, that he had mortgages on, now he had 7 properties free and clear. So even if nobody rented those properties out, he didn't have to worry about a mortgage payment. Yes, he'd have to pay his taxes every year on the properties, but these type of properties that he had were like starter homes. They weren't very expensive. So even just carrying the property taxes annually, he could have done that. The benefit is in the free and clear system is you own it outright. And the way to find out if you own something is stop paying the bill. If you stop paying that car payment, guess what happens? Somebody's going to come get that car. Who's getting that car? The owner of the car. So you don't own anything until you paid for it. So that's how you find out who really owns something. Stop paying your mortgage and see what happens. Somebody's going to come and get this house, right? They own the house until you finish paying it off. So you are in the process of buying this home. You are in the process of buying this car, but you don't own it. And that was my dad's thinking. He said, okay, in the downtime, in a recession, I won't have to worry about somebody coming in and foreclosing on these investment properties, these rental properties, because they're paid free and clear. And that's what he talked about, the free and clear system. That was just a little bonus. So anybody that's in real estate, you may want to take that advice. You may want to look at it. You may not. You may want to continue to leverage your credit to buy more. But once again, in the downtime, it can hurt you. But if you have them paid free and clear, it's golden. So that's today's show, guys. Once again, I really want, myself included, everybody to try to step their game up. If you're new starting your business, that's fine. If you're in business already, let's step it up. I'm trying to take mine to another level in 2018. And the only way to do that is to think bigger and think deeper. One of the things with our economic situation is we're always going to be borrowers. Oh man, I can't get this loan. Bank wouldn't give me this loan. Or yeah, they did give me the loan, but damn, look at the interest rate I'm paying because I got a couple of dings on my credit. So we got to stop thinking about that. And I always talk about consumers versus producers. We need to be the producers. We need to start having people come to us for money instead of going somewhere else for money. The money business is big business. Trust me, it's big business. We all know that. Like they said, the banks are too big to fail. They weren't going to let the banks go out of business, not all of them, during the economic crash. Too big to fail. So when you can become the lender, that's when you have control. If you can pull your resources with some serious-minded people, and once again, I'm all for buying the block, but sometimes we need to buy the block with our own money versus buying the block with somebody else's money. Because once again, you're beholden to the lender. You're beholden to the lender. So let's start trying to be the lender. And I know it sounds like a daunting task, but becoming a private lender is not that hard, especially if it's just your money, right? But if you pull other people in there, you create an entity, you have somebody manage it and make sure that you have oversights on it. And you make sure that it's legally in compliance and financially in compliance when it comes to receiving interest payments. And once again, these are short-term lending situations. Hard money, maximum 6 months, transactional funding, maximum 3 days. Hope you guys enjoyed the show. And before we close out, guys, check out my YouTube channel, Black Entrepreneur Blueprint. go to YouTube and check it out. I'm actually going to put up a couple of videos that are not on the podcast about some other subjects and topics pertaining to entrepreneurship. So go ahead and sign up for Black Entrepreneur Blueprint and be a subscriber of the YouTube channel also. And once again, guys, please continue to spread the word about the show, the podcast, the blog. Once again, every episode we're growing and growing and growing. And I attribute that to the BEB family. That's you guys. And please continue to spread the word. Please. Once again, we're trying to get as many downloads as we can. Also, if you need to connect with me, if it's something long, hit me on my email at jjones@blackentrepreneurblueprint.com, JAYJONES at blackentrepreneurblueprint.com, Facebook Black Entrepreneur Blueprint, Twitter jjones001, Instagram jjones for real, the number 4 REAL, and YouTube. Once again, YouTube Black Entrepreneur Blueprint. Type it in and be a subscriber. Once again, I'm going to start doing a lot more videos in 2018. That's just another way of trying to expand the brand. And please subscribe to Black Entrepreneur Blueprint on YouTube. Love you guys. See you same time next week. Peace.